Right, guys, so welcome to strategy 3, which would be on selling covered calls. So for the first two strategies, we'll focus on being buyers, right? So we buy call options, we buy put options. So in this strategy, we are going to take on the role of the seller. So we're going to be selling call options to collect premium. And we're going to do it when we're covered by the shares itself. So let me explain what that means. So the main purpose of this strategy is to generate additional income from your existing stock investment portfolio. So this strategy is suitable for those of you who already have an investment portfolio of shares. So usually when you own a portfolio of shares, how do you make money? Well, as you hold the shares over time, it will increase in price. So you make money through capital gain. The second thing is over time you collect dividends from the company for those companies that pay dividends. But there's a third way you can generate income from your stock investments, which is to sell call options against the shares that you own. And by selling call options, you're collecting premium. So by doing that, you've got three ways to make money on your investments, right? Capital gain, dividends, and premium. So this increases the overall return of your investment portfolio. So let me break down the strategy on how it works. So the first thing is, again, you have to hold shares in a company in the first place. And you have to hold at least 100 shares of a company. So let's imagine you're holding 100 shares of Coca-Cola and you're holding it for the long run. And you're confident in the long run, the shares will increase in value. But in the short term, the stock could be hitting a resistance level or going sideways, or kind of like moving down or moving up too slowly. So you want to make some extra money while you're waiting for the shares to go up in the long run. And in the short run, how do you make some money from it? Well, you can sell out of the money call options on your Coke shares. And by selling the options, you're now collecting premium. So for every 100 shares you own, you would sell one contract of call options. And you want to sell call options that are out of the money. And you're hoping that by selling the call options and collecting the premium, the call options would expire worthless or decline in value so that you can keep as much of the premium as possible. So again, like I said, you collect the premium and hope that the option expires worthless. So let's take a look at this chart over here. So Coca-Cola is a good example of a company you could hold for the long run. How would you know? Well, usually for long-term investments, I like to look at the long-term chart. For example, this is the 10-year chart of Coca-Cola. And you can see in the long run, it always goes up. It's a pretty predictable company that's recession-proof. All right, so you can see a long-term uptrend. But on the right, you can see the daily chart, the short-term trends. So you can see that Coke was kind of like at, $41, and it was on a strong uptrend, went all the way up, for example, to $50, 50.5, right? And when it reached there, it was a bit overvalued, right? A bit far from the moving averages. And then it went up there again, 50.5. So it formed a resistance. So in the short term, I don't think Coke's going to go up very much. I think it's going to, retrace back down sideways for a while. So you know what? I'm going to decide to sell Coca-Cola call options at the 51 strike price. So again, the price of Coke is now $50.50. So the call options with a strike price of $51 strike price is out of the money. Okay, so I'm selling the one strike out of the money call options, and the call options happen to be worth $1.50. Again, you can check this on the option chain, right? So I'm selling the call options, I'm collecting $1.50. So multiplied by 100 shares, I'm collecting $150 of premium. Now recall, when you buy a call option, as a buyer, you have the right to buy the shares at a certain price, correct? But now as a call seller, when you sell the call, you're obligated to sell the shares at the strike price. So what it means is by selling these 51 calls, I'm now obligated to sell my Coke shares at $51. So if Coke shares go above $51, the options will become in the money, and I could be assigned by the call buyer. And if the call buyer exercises his calls and I'm assigned, I've got no choice. I'm obligated to sell my shares at $51. But I'm okay with it. You know why? Because I bought my shares, much lower. So if I sell it at 51, I'm already making a profit. Okay. Of course, the downside, if the price goes to 55 and $60 in the short term, I could lose out because I'm now obligated to sell my shares at $51. But by having that obligation, I'm collecting $150 upfront in premium by selling the call option. So let's take a closer look at how this works. So once again, this is the Coke chart. So Coke shares are going up, and over here you can see at $50, it's forming a resistance. So I don't expect Coke shares to go up very much in the short term. I expect Coke shares to again go sideways or go down, so I have to make some extra money. So what I do is I sell the Coke calls at the 51 strike price, which is above where the price is right now. So I'm selling out of the money calls. And again, by checking the option chain, you can see what the calls are worth. In this case, the calls are worth $1.50. So multiplied by 100 shares, I'm collecting $150 of premium. So two scenarios. Scenario number one, Coke shares remain at or below $51. So if that happens, the options will expire out of the money, expire worthless, and that's the best case scenario. So I get to keep the full amount of premium which I have collected. And again, we like to sell covered calls with about 30 days left to expiration. So they quickly expire, they're worthless, and I get to keep the call options. Now, second scenario, it is possible that Coke shares suddenly go up, all right, break above resistance, and they go above $51. So what happens now? So when this happens, the call options that I sold are now in the money. So the person who bought my call options may exercise their call options, which means they have the right to buy the shares from me at $51. I am now obligated to sell the shares at $51 as a call seller. So again, I'm obligated to sell my 100 shares at $51. Now again, I already have the shares, right? So what will happen is my 100 shares will disappear, okay, and I will get the proceeds of the sale at $51. So either way, I'm making money. The only thing is, in the second scenario, if Coke shares go to $52 or $55, I don't get the extra upside because my gains are capped at $51. So my upside capital gain is limited, but I still keep the premium and I still sell it at $51. And again, I already own the shares at a much lower price, so I'm already making my profit on that. So again, either way, I'm profitable. So this is a no-lose strategy. If you first own the shares that are profitable, all right? So again, if you take a look, this is the risk to return graph. On the left would be owning the shares itself. So if you own Coke shares by themselves and the current price is $50, from where you are right now, this is your risk profile. As the stock price increases, you have unlimited profit potential. As the stock price goes down, you will lose money from your current investment portfolio. But again, these are on shares that we know will increase in the long run. So we are okay with short-term downside fluctuation. Now, once I sell a call option against my shares, instead of this dotted line, my risk profile graph will look like this bold line, right? So what happens now? So again, now realize that as the stock price goes up, I'm still making more money from where I am right now, but my gains are capped. My gains are capped at $51. So anytime the share price goes above $51, I'm not making more money because I'm obligated to sell at $51. So my profits are limited. But if the share price goes down, again, well, yeah, my shares lose money as per normal. But by collecting the extra $150 in premium, notice my break-even point is lowered. Instead of breaking even at $50, my break even is now $49.50 because of the additional premium I've collected. So let's take a look at a case study. Assuming you own 100 shares of Intel in your portfolio, and the current value of the shares, you can see from the chart, the shares are trading at 47.08. So you own 100 shares, which means the value of your shares are currently $4,708. So you know that the shares are going to go up in the long run, right? It's a good company, but in the short term, you can see it's kind of moving sideways and it's below the moving averages. So you're kind of like bearish in the short term. So to make some extra income from the shares you already own, you decide to sell one contract of the Intel call options. So you want to sell covered calls against your Intel shares. So you decide to sell the February calls. Why? Again, usually we sell options about 30 days or so to expiration. So again, when we sell calls, we want it to expire as quickly as possible. So we are no longer obligated, correct? So if you check out the option chain on my left, let's take a look at that. So the current month is January. So we could select the February calls. So you can see over here it's 43 days to expiration. So that's fine. So, close to 30 days, that's fine. So 43 days to expiration. Next, we have to choose the strike price. Now, the calls, the price is currently at 47.08. And you can see that there's a strong resistance at about $49. Right? So again, when you're selling the calls, you want to sell it out of the money and you're hoping that the price will not reach that level, because if it reaches, then the options are now in the money. So you could sell the 49 calls or you could sell the 48 calls. Now, if you sell the 49 calls, it'd be kind of safer because you don't think it's going to reach there. But again, when you sell calls that are too out of the money, the premium you collect could be too little for it to be worthwhile. And again, if you sell calls that are too close to the current price, you get good premiums, but it could reach that strike price easily. So sometimes you got to make a decision what you're comfortable with. So in this case, I decide to sell the 48 calls, which are just one strike out of the money from $47. Okay. So if I sell the 48 calls, how much do I get? So check out the option chain. Under call options, look for 48 calls. There we go. So the 48 call, you can see the ask price is 191 and the bid is 183. So again, when you're selling calls, you're selling at the bid price. You're selling at the bid price. If you want to sell at the market price, you're getting 183. Now, if you sell the 49 calls, which are higher up, then you're getting 137. So notice that when you sell calls that are, further out of the money, $49.50, the premium that you get, as you can see, gets less and less. So you got to decide what you're comfortable with. All right. So in this case, again, let's assume we sell the 48 calls at 183. So question, by doing that, how much do you collect? What's the total premium? That's right. You get 183 multiplied by 100 shares. So you get $183 of income. Okay. So what's your return on investment? So again, your initial position is 4,708. So what you can do is take your calculator, and if you take $183 divided by 4,708, let me kind of work it out over here. So 183, that's your income, divide by 4,708. That would give you 3.9% return on your original capital, right? So you're getting 3.9% return in 43 days because the option will expire in 43 days. So it's a 3.9% return, good for 43 days. It's not bad, all right? So again, if you were to keep doing this every 40 days, right? Keep selling calls out of the money, collect the premium, sell the calls out of money, collect the premium, right? If you keep doing that, again, in a year, you have got about 9 40-day periods. So if you multiply 3.9% times 9, that's a 34.9%. That's about 34.9% return on your investment, right? So in other words, even if the share price of Intel doesn't go up for a year, even if Intel doesn't pay any dividends, you are generating 34.9% return on your Intel shares simply by selling call options and collecting premium for a year. So imagine with this 34.9% return plus the dividends you get, plus the eventual increase in the share price, it will really boost your overall returns on your Intel shares. And that's why people who own a large amount of shares, they sell covered calls to get extra income, to increase their returns on your overall portfolio. All right, so stock selection. What stocks do we want to sell calls against? We only want to write covered calls on fundamentally strong stocks that we know will rise in the long run. And you don't want to do this on shares that are not really strong, really good shares. Pretty risky. Now, ideally, the best kind of stocks to write calls on are stocks in the Dow Jones. So again, the Dow Jones is an index of the largest companies in the market. So McDonald's, Disney, PepsiCo, Pfizer, Procter & Gamble, Visa, Boeing. So these are the huge companies that in general are more stable, more predictable, and will generally rise in the long run. So these are the best kind of shares to own and to sell calls against to generate extra income. You want to avoid biotech and pharmaceutical companies because they can be really volatile. Okay, like, if a biotech company misses earnings or they've got a patent that was not approved, the share price can drop drastically. So these companies are not really predictable, really volatile, and we want to avoid those for our long-term investments or to sell calls against. Next, avoid selling calls when a company is due to announce its earnings. And you can check the next earnings announcement on the charting platform. There's a kind of like a question mark icon that tells you that earnings is going to be announced. And so companies announce earnings once every 3 months. So avoid selling covered calls just before earnings are announced. After earnings are announced, go ahead and sell covered calls. Next, entry strategy. So you own shares of great companies. When's the best time to sell calls? The best time to me would be when the stock price is temporarily moving sideways in a consolidation or even trending downwards. Now remember, if you own shares of a company and the price is on a strong uptrend, really bullish, you don't want to sell calls when that happens because the price is going up strongly. You're getting capital gain, right? By selling calls, you are limiting your upside, and there's a risk that your shares could be called away. Remember, when you sell calls, you're obligated to sell the shares at the strike price. So if the share price goes up, you're obligated to sell the shares and you miss out on the capital gains. But if I'm owning shares and temporarily the shares are kind of like going sideways and there's a level of resistance, which I don't think the price is going to go above in the short term, I'll then sell calls at that resistance level or just above it and collect premium as the price goes sideways. Or if the price is on a temporary downtrend and I'm holding the shares, I could be selling calls and collecting premium to offset the temporary loss in value. Next would be the best time to sell options. In this case, selling call options, best time is when implied volatility is high. Recall that when volatility is high, options are relatively expensive. And that's when we want to sell the options, because when we sell, we get higher premiums. It's like during hurricane season, insurance companies sell insurance at higher premiums. That's when we want to sell options. We want to be like the insurance company, right? As an option buyer, we want to buy when options are relatively cheap, when implied volatility is low. So in this case, because we are the seller, we want implied volatility to be high. So again, on the charting platform on Thinkorswim, you can check the IV percentile. And anything above 50 tells us that options are expensive. We can receive good premiums when we sell those options. I like to sell call options 1 to 2 strikes out of the money, or sometimes even more. And again, one way is to check the delta of the option. Again, over here under calls, if you look at the delta column, I like to sell calls when the delta is between 0.4 to 0.5. So I could sell the 47 call, I could sell the 48 call, or the 49 call. Again, the higher the strike price I'm selling, the lower the premium I'm collecting, right? The less premium I'm collecting, and the lower the delta. A delta of 0.4 to 0.5, what does it mean? It means there's only a 40 to 50% chance the options will expire in the money. And that's what I like, because it is less likely you will expire in the money. It will expire out of the money more likely, and I free of my obligation, and I get to keep the premiums. Next, sell options with about 35 to 40 days to expiration. Because recall that in the last 30 days, that's when options lose value the fastest. That's when theta, the time decay, the time value, drops the fastest. And as a seller of the options, we want that to happen. Because when we sell the option and the option declines in value really fast, that's when we collect as much premium as possible. We want to sell high and buy back low, or not buy back at all when it expires worthless. So that's how it works. So what does the risk to return chart look like for covered call strategy? So let's take a look at another example. So looking at the chart here, this is of Yum Brands, and assuming you own 100 shares of Yum Brands, and the current price is 94.13 over here. So that's the current price, and as you can see, the price has made what we call a bearish pin bar. So it looks like it's not going to go higher for the short term. You think it's going to go sideways or it's going to go down. So what you're going to do is going to sell a call right above the current price. So you're going to sell one contract of the Yum March 95 calls at the 95 strike price. So if you check the option chain, the premium that you collect by selling this call is $2.40. So you don't think that Yum is going to go above 95 anytime soon because of the price action. So you're going to sell the call to collect that 240 premium. So what does the return and risk graph look like? Well, first of all, this is the option chain. You can see these are the calls and the 95 call strike. If you go down the line, that's 95. These are the March calls. So it's about slightly over 30 days to expiration, because now it's early February. In fact, it's 40 days to expiration. Okay, so the price of the calls, as you can see, is 240 over here. Right, so we collect 240 in premium. So what does our chart look like? So again, you'd have to draw the chart, click on the Analyze tab, and the software will draw the chart for you. So it looks something like this. So again, this is the stock that you already own, plus the short call. So combine it together, it will look like this, right? So the green line going up, and then there's a maximum profit that you can make. So the current price is now at 94.13. We are right now here at this current price. So we sold a call with a strike price of 95, right? So that's our call strike. So again, what's the maximum profit that we can make? So once we sell a call, we are capping our profit. Because remember, when you sell a call at 95 strike, what does it mean? It means now you are obligated to sell the shares at $95. So even if the share price goes to 96 or 100 in the short term, you're obligated to sell it at 95. So the most you can make is now $95. But you collect the premium in order to have this obligation for 40 days. So the maximum profit you can make, how do you calculate that? Well, it's over here. So right now the stock price is at 94.13, correct? And you are obligated to sell it at 95. So how much would you make if it goes to 95 or beyond? So 95 minus 94.13, the maximum you would make would be about less than $1 in terms of the capital appreciation, right? But you collect 240 from selling the call. So your maximum profit would be 327 per share times 100. Your max profit is $327 for this trade. So some of you may say, hey, I've got a limited profit, but it looks like my loss seems to be unlimited, right? The price drops, okay, looks like, I could be losing a lot of money, right? But remember that you already own the stock, okay? So you believe that this stock that you own will go up in the long run. It's a fundamentally good company. So you already own the stock. So you don't care if it goes down in the short term because you know it will go up in the long run. But because of the temporary weakness in the stock, you want to sell a call to collect some premium, waiting for it to go up eventually. So you're not so worried about the downside to this because you already own the stock in the first place. So again, the loss on this trade is the same loss of you holding the stock in the first place. But because you sold the call, you are not now collecting a premium. So if the stock price goes down, instead of losing what you normally lose on the stock, at least now you get $240. So it kind of like cushions the short-term loss on the stock. But it's an unrealized loss because you're not selling the stock, you're holding it for the long run. Okay, so once you're in the trade, once you've sold that call, how do you exit the trade? Now, there are three possible scenarios on how you exit a covered call strategy. Okay, let's look at the three scenarios right now. Scenario number one would be the current price is at 94.13, right? And you sold the call at a 95 strike. So the first scenario would be the stock price stays where it is, right, or goes down. So if the stock price stays where it is and goes down, what happens to this call option that you sold to the call buyer? That's right, this call option will expire worthless at expiration. So when it expires worthless, what happens? You realize the full premium of the call, because when you sold the call, you collected the premium. And now the call you sold loses value till it becomes worthless. So you keep the full premium, right? So that's the first scenario. Now the second scenario is you could choose to buy to close your short call 1 week before expiration. Okay, so remember that when you sell the call, you're selling to open a position. You can buy to close the position, right? So you're selling the call at, again, what's the price? About 240, right? You're selling at 240, and when you sell at 240, you want to buy it back at a lower price. So you sell the call at 240, the call loses value, maybe the call goes to 40 cents, you buy it back at 40 cents, you're still making money because you sell high, you buy back low. So that's the second scenario where you buy to close the short call, 1 week before expiration. And the reason is because if the stock it's near the strike price, you don't want to wait for the expiration date, because before that anything could happen. It could go in the money and it's too late to buy it back. 1 week before expiration, you quickly buy back your short call and hopefully make some profit from there. So you don't make the full premium, but you make maybe 80% of that premium. So that's a pretty good scenario as well. So that's this scenario. The second one is if the stock is near the strike price. Now, the third scenario is one where Once you sell the call, the stop price goes up, right? Goes all the way up, for example, goes up and goes beyond your strike price. So in that scenario, guess what? The person who bought your call may exercise the call option. So what it means is that the call buyer has the right to buy the shares from you at the strike price, and you're obligated to sell it to the call buyer, right? You're obligated to sell at $95. So if the call buyer exercises the option, you are assigned. Okay, when you're assigned, you have no choice. You're obligated to now sell your shares at the strike price. And that's why you have to already own the shares in the first place. So in this scenario, what happens is that the shares you own would be deducted from your account. It will go to the buyer of the call. You would lose your shares. But of course, you'll get the cash from selling the shares. So you see in your account, you will suddenly see a lot of cash in your account. Now you may say, but Adam, I didn't want to sell the shares. I want to hold it for the long run. No worries, because now you got the cash. You can use the cash to buy your shares back. All right. At the same time, keep the premium that you got from selling the call. Okay. So in a way, it's a no-lose situation. In all three scenarios, you will make money. Okay. So let's look at the scenarios again. All right. So scenario number one would be the stock price falls far below the strike price. So again, in this scenario, you sell a call, right? And the stock price, falls all the way down, and it's very far from the strike price. And it's, more than 2 strikes out of the money 1 week before expiration. And you think, chances are the stock is not going to go above the strike price because it's so far away. Just let it expire worthless. So let the option expire worthless, and you get to keep the maximum profit, which is the premium you collected. Now, at the same time, remember that we want to keep repeating this process so we get, additional income every 30 days or 40 days. So once the option expires worthless, what do? You sell a new call option. You sell to open a new call option with a new strike price, which again is slightly out of the money from the current price where it is now, and again with a new 35 to 40 days to expiration. And you keep repeating this process and collect premium again. So that's scenario number one. Scenario number two would be 1 week before expiration, the stock price is still near the strike price. It could be at the money, it could be slightly out of the money, slightly in the money. So in that case, what do? Okay, so what you can do is to roll the short call option into a new short call option. So what does rolling mean? Rolling means you buy back the short call and you sell a new call, which is what we did here anyway, right? So you buy to close the original short call for a profit or sometimes even a slight loss. But even if it's a slight loss, no worries. Because the stock price would have gone up and you have made money on the capital gains on the stock. So that offsets any losses on your short call position. So buy to close a short call option and simultaneously sell to open a new call option at the same time. All right. And the new call option that you sell would be again 1 strike out of the money or more. And again, with a new date to expiration, giving you another 35 to 4 days to expiration. So the moment the first call you sold is going to expire, close it, sell another call with another 30 to 40 days left. And as that reaches nearing expiration 1 week, close it, sell another one, 30 to 40 days left. Again, by selling these calls with many days to expiration, 30 to 40 days to expiration, what happens is that as time moves on, the option loses value, theta decay, right? So as the theta, the time value is decaying, you are benefiting from it, okay? Because you sell it high and you get buyback lower. All right, scenario number 3 I described just now again, which is you sold the call and the stock price zooms up above your strike price and it's deep in the money and it gets exercised by the call buyer. So the call buyer says, okay, I'm exercising the call, so you get assigned. What happens? Well, first of all, you keep the option premium, so that's good. You get the premium which was 240. But now 100 shares are deducted from your account. So you lose your 100 shares of Yum Brands. But the cash is credited to your account. So you suddenly see a lot of cash in your account. So what you want to do is to use the cash that you have to buy the shares back, which you had to sell. Buy it back and sell a new call option again, right? So again, sell new call option, which is out of the money, which you don't think that the price will reach in the next 30 to 40 days, and with a new date to expiration. So basically, these are the three scenarios on how to exit a covered call strategy. And in the next part, Bang will run through in greater detail during the live practical examples. So stay tuned for that. Now, if you're still not clear about how to roll the original short call into a new short call, let me run through it step by step using, again, the Yum Brands example. So originally in February, Yum Brands was at 94.13, correct? And we decided to sell the March 95 calls, which was out of the money. So when you sell the calls, you got 240 in premium. And as time goes by, assuming the stock price doesn't go above the strike price, what happens? The call you sold loses value because of time value passing. The call loses value, and 1 week to expiration, the calls may be worth 40 cents. From 240, they're now worth 40 cents. So you decide to buy to close the original short call, right? So now you buy it back at 40 cents, the exact same call with the same strike price, okay? So you sold it at 240, you buy it back at 40 cents, what's your net profit? That's right, minus 240, or rather 240 minus 40 cents, net profit you get is $2. So your net profit is $2 from this trade. So once you have bought to close this short call, what do? You want to repeat the process. So now it's March, it's 1 month has passed. So you sell a new set of calls, and this new call you sell would be again 35 to 40 days to expiration, which would be the April calls now. And because now the stock price could be at $95, you're selling it slightly out of the money again at 96. So now you sell these new calls and collect the new premium. And again, 30 days later, when it's going to expire, you may again buy to close these calls at whatever, maybe there's 20 cents left, and you get to keep the net profit, right? So that's how you keep repeating the process, right? Sell a call, 30 days later, buy it back at a lower price, sell a new call, repeat the process, and collect premium along the way, right? Of course, in the event where the call is really out of the money, you don't have to buy it back because it expires worthless. You have to buy it back and you keep the full premium. So that's basically how it works. So what are the pros and cons of this strategy? Well, here are the advantages. There are a lot of advantages. Number one, first advantage is you collect premium as extra monthly income on your investment portfolio. And again, this would add up to about 2 to 3% a month, which could be potentially 30 to 35% a year on top of the dividends you're already getting, on top of the potential capital gains for the future. You generate 30 to 40% returns on a stock, even if the stock moves sideways or moves down in the short term. The third advantage is by selling calls and collecting premium, you are actually reducing the cost of owning the underlying stock, because you're kind of like making back your money, right? Next advantage, this approach can also be used to exit a stock position at a target price, and you get paid while waiting for it to be called away. So what does that mean? So imagine you bought a stock at $50 and your target price is $60, correct? So when you buy at 50 and it's going towards 60, instead of just selling it at 60, what can you do? You can sell the 60 call, right? Sell the 60 call, because again, when you sell the 60 call, or you sell the call with the strike price of $60, what happens? You collect premium, all right? So if the stock doesn't reach 60, what happens? You keep getting the premium for free. You get free money, right? And if it reaches $60 and above, what happens? Then you are obligated to sell the shares at $60, which is what you want to do anyway, right? So it's again a win-win situation. That's the first advantage, or that's the last advantage, right? Now, what are the risks? There really aren't many risks, okay? Now, but the main risk would be you are capping your upside capital gains in the short term. So in the short term, the problem if the stock suddenly runs really fast and it goes all the way up, I'm sorry, you don't get to keep all those profits because you're obligated to sell at the strike price. So that's the main disadvantage. The other one would, of course, be the same downside risk as holding the stock in your portfolio. Obviously, if the share price goes down, you could make short-term losses. But again, even if you don't sell the calls and you own the shares in the first place, it will be the same thing. So by selling calls, it doesn't incur more risk. In fact, it lowers the risk of you owning the shares in the first place. And that summarizes the advantages and the risk of selling covered calls.